Is the stock market safe again? Is the worst behind us? As I record this video, the S&P 500 has clawed back all of its losses for 2025. And as you can see in this chart by CNBC, the S&P 500 is up just a little under 1%. So what does this mean for us? Are the big risks behind us? Can we go back to things as normal, or do we need to be cautious? And to answer that, I want to share with you some really important data to show historically what happens when the year starts off negative. And we're going to look at this great article by MarketWatch. It says, as the Dow and S&P 500 claw back their 2025 losses, they're setting up for an extremely rare comeback victory. And that's what I want to talk about. Just how unusual it would be. It doesn't mean it's not going to happen, but how unusual it would be for the year to finish positive. So going into this article, if stocks keep rising from here, it could result in an extremely rare accomplishment. Out of 15 total instances that the S&P 500 has seen such a steep inter-year drop since 1950, it's only managed to recover and finish in the green, finish positive 3 times. So let's look at this data. They go back all the way to 1950. The first case here is 1957. You can see the year-to-date low was down 16.5. The yearly return ended up being negative. You can stop the video and look at this, but just some memorable ones. In 1974, the low was down 36%. That'll take your breath away. It ended up finishing the year down 30%. Another one is 2002. The inter-year low was almost 33%, 32.3%, and it ended up finishing down a little better than 25%. It finished down negative 23.4%. Of course, you can see here 2020, COVID, the market experienced its fastest drop, down a little over 30%, and it ended up finishing the year, to the surprise of many of us, up 16.3%. 2022 was the most recent one. The market was down almost 25%, ended up finishing down almost 20%. But you can see that there were 3 years, 1982, 2009, and 2020, where the market actually finished higher after having a big drawdown during the year. So what does this mean for us? Well, what it means for us is, first and foremost, it just shows how difficult it is to predict how things are going to go. I mean, if before 2025 had started, we had said, hey, in the year coming ahead, we're going to have these massive tariffs. We're going to have tariffs on and off, and I'm not being critical. This is not a political channel. I do think that some good trade deals will come out of this. I also think there's going to be some challenges that will come out of this. But if going into the year, we had known how the tariffs were going to play out, just the magnitude of the tariffs and the fact that they'd be in place for a while and then out of place, I think a lot of people would have said, boy, that's going to be devastating for the market. The market did go down sharply. We've seen that, but we're not out of the woods yet. And we've seen all of those losses get clawed back. So we can see how unpredictable things are. And it's why I think that the secret is not trying to time the market, but it's time in the market. And the challenge with timing the market is, you've got to get so many factors right. First, you have to get what's going to happen right now. In this case, it would be that, very large tariffs were going to be placed on countries. And then you have to say, well, what's the stock market going to do? Initially, the stock market went down, but you can see the stock market doesn't always do what you think it's going to do. Same thing in 2020. If you had told me there's going to be a global pandemic, we're going to shut down businesses, we're going to be forced to stay at home for a fairly long period of time, I would have said, the market is going to have a very negative year if any or all of that were to happen. But what we don't know is what are the responses gonna be? How are people gonna react to it? And the pandemic's a classic example. There was a lot of stimulus put into the stock market, and we ended up being 16+% positive for the year, and that is a very solid year. So it's super complicated. So what do we do if timing the market doesn't work? The best thing to do, and I was a financial advisor for over 20 years, um, and helped people navigate this question, help people over 2 decades look at years where things looked like they were gonna be really bad, multiple years where the stock market was down, in navigating those challenges. But if you go back to the fundamentals, and if you believe that in the United States and in the world, companies are going to continue to work hard to figure out ways to do things better, faster, and cheaper. If you believe in that, then over time, eventually that should result in companies increasing their earnings, increasing their cash flows, and that should be, there's no guarantees, this isn't financial advice. I don't know your situation, but in a world where companies continue to generate more and more cash flows, that should result in good things happening for the stock price. So again, as a financial advisor, my counsel to my clients was let's get a long-term strategy in place, an asset allocation where we have enough exposure to stocks that though we can beat inflation over time, that we have a good chance of meeting your goals, but not so much stock exposure that when scary things happen, it's the mental side of things that cause people to blow out of their stocks. That can be really the challenge. They become a forced seller in a down market, and I think that's the biggest reason that people lose over the long term in the stock market is they become a forced seller in a down market, and that can happen because the pain of loss is just too great and they want that to stop, and so they blow out of their stock investments. That can happen because maybe people have too much debt. Maybe they're a real estate developer. Maybe they have a company and they borrowed money and the bank needs their money back and they just don't have the cash. So they have to sell what they can sell. And one of the good things about the stock market is it is liquid. It's relatively easy for public to get out of investments that trade on the public exchanges like the New York Stock Exchange. So that allows people to access their money, and that then allows them to unfortunately, become forced sellers in a down market. And then the other one is for retirees, right? We have so much money each year for our living expenses that we need to take out. And that's one of the reasons I encourage people not to think of their asset allocation as, I'm 60% in the stock market, 40% in bonds, or whatever the asset allocation mix is. But I encourage people to think about how many years worth of living expenses do you have in bonds so that you don't have to be a forced seller in a down market. You don't have to sell your stocks. So is the stock market safe? Have we averted disaster? I don't know. But what I do know is having a long-term asset allocation and being able to stick to that is one of the best ways to have long-term success in the stock market. If you enjoyed this video, the YouTube algorithm says this is the next video of mine specifically for you that you should watch next. Thanks for watching this one. Bye-bye.